Let's talk to Connor Campbell. He's a financial analyst with Spreadex. Morning to you, Connor. Right, we've got three equities that are reporting this week to run through in this slot. Let's kick off with WH Smith's. In terms of down 7% in 2018. This was a fantastic stock to be in the last few years.
Yeah, I think last year it was up 49% over 12 months. You know, it ended the year at an all-time high. So it literally couldn't have got any better for WH Smith, really. It had an absolutely fantastic year. Given that, if you weren't looking at its figures, common sense would perhaps dictate a mainly high street stock in basically doing what Amazon does should have long ago been wiped off the face of the earth, basically. But it's managed to pivot so strongly towards the travel division, which is where its strengths lie, that it's still doing fantastically well, despite sort of the ever-looming presence of Amazon. Its half-year figures back in October sort of bear that out. 9% rise in sales at the travel division with a 4% rise in like-for-like sales. That countered a 4% like-for-like drop at the high street with a 5% drop in total sales. So, you know, group revenue was still up 2%. It was the first time in history that profits and revenue were greater at the travel division than the high street division. So it's been a long time coming, but now finally that shift, it's shifted towards the travel division, and that's only going to increase in the next couple of years, which is only going to improve the situation at WH Smith more and more.
Yeah.
And impressively, I think pre-tax profit was up 7% to 140 million, because despite like-for-like sales and overall sales being down at the high street, profits were flat at 62 million. So the fact that the sales drop didn't really have any impact on what really matters, just really shows that WH Smith knows what it's doing at the moment. It also announced back in October a £50 million share buyback. I think diluted earnings per share and the full year dividend were both up 10%. Really, really, really strong figures that, I think you could look at the chart and be, it's at all-time highs, it's a bit high, but its figures really justify its rise. In terms of its report on Wednesday, as you said, it's fallen 7% since the start of the year. I think that's largely down to it wasn't necessarily a great Christmas for UK retailers. There wasn't a lot of good news coming out, and you had plenty of pretty horrific updates coming out of the festive period. However, WH Smith sort of, on both sides of its company, should benefit from the festive period. High Street, they're going to see an increase in footfall over Christmas, even if it's just people popping in for stocking fillers and things like that. And the travel division, people travel a lot over Christmas, and be it they're looking for a book to take home for their loved ones or just something to read on a plane. Those stores should see a boost over Christmas. I think in terms of the reaction to its figures on Wednesday, the travel division should be strong as long as it can maintain that 4-5% rise in like-for-like sales, and ideally some kind of reduction in the like-for-like sales drop at the high street. If it can get that down to 3%, I think investors would be pleased with that. In terms of what our clients are doing, they're really heavily buying around the 21.25, 21.50 mark. I think if it was still at the all-time highs it was at, it might be a different story, and I think our clients might be looking at it thinking, it could stand to fall something after its figures. But I think because it's sort of the other side of the main brunt of sort of the retail reporting period in January, it could stand to benefit from, see a rather, decent rise after its figures on Wednesday, just because of how sharply it's fallen since the year began.
Okay, well, let's move on to Diageo. Excuse me. Down 5% this year. Chart looks quite toppy to me. What are you thinking here?
Interesting. It's a very similar year in terms of market performance to WH Smith. Ended the year at all-time highs. Very strong. I think it was its full year figures back in July. Pre-tax profits were up 25% to a huge £3.6 billion. Reported net sales were up, I think it was 15% to 12.1 billion. It announced a 1.5 billion share buyback, said it was going to raise its organic operating margins by 175 basis points by June 2019. Anyway, look, the figures were fantastic.
Tick, tick, tick.
September sort of pulled that back a bit slightly. It wasn't really releasing any figures, but said that its second half of its new financial year would be a lot stronger than the first, due to a combination of, I think it was the later timing of Chinese New Year and a ban on highway alcohol sales in India. Basically, I think those were two things that caused it to think that the second half of the year is going to be a lot stronger. But it still kept its forecast for the year at the same. No real reduction there. If you look at what is expected to report on Thursday, its first half figures, they're not that bad. I think organic growth is expected to drop from, I think it's 4.4% to 3.7%, but that still takes organic net sales to 6.6 billion, which is more than half of what it managed total in July. And I think adjusted pre-tax profit is expected to be up 4.3% to 2.14 billion. So even with an ostensibly weaker first half, its figures are still very strong. That's why we've seen our clients buying around that £25, £26 mark. I think, again, like WH Smith's, because it's pulled back since the start of the year, there is room for it to, if not get back to those all-time highs, at least get somewhere between those figures.
Okay, let's wrap up with ASOS. An extraordinary move. I wish I'd bought into this company many years ago. Onward and upward, up 1% this year.
Yeah, compared to, if you look at a lot of retailers, I think if you look at most of its online peers, say for Boohoo, I think Boohoo managed a 100% increase in revenue over the same 4-month reporting period that ASOS is going to be covering on Thursday. So online sales, despite an overall weak retail period for the UK, online sales have held strong. Companies like ASOS have performed very well. In terms of its full year figures, just to give a taste of what investors could be expecting, I think group revenue was up 33% to 1.9 billion. UK retail sales were up 16%. Internationally, they were up 47%. I think they were up like 45% in the US, which is, a gold mine basically. Pre-tax profit was up 145% to 80 million, which is bonkers.
Yeah.
Everything was strong. Active customers up 15.4%. Every figure, just huge ticks all across the board. In terms of what it's going to post on Thursday, I think ASOS is aiming for 25% to 30% overall sales growth in 2018. So any figures up to the upper end of that, I think investors will be pleased at. Maybe they want something a bit more robust given it is Christmas, or was Christmas, sorry, and given the strength of Boohoo sales. So those are the kinds of figures you're looking at. From our clients' perspective, however, by and large, they're selling around the £68, £69 mark. I think it's, it hit £70, I think it was 4 years ago now. It was around the same time 4 years ago. So it's getting towards all-time highs. It's held on to its growth in the last couple of weeks. So it's in a bit of a danger zone. I think we've seen with ASOS in the past that despite some heady figures, investors are sort of inevitably disappointed because they're not posting, 50% sales growth or something like that. So there is always the risk with ASOS being as high as it is that it could disappoint. And I think, well, not disappoint in terms of its figures, but just the market reception perhaps be a bit more muted than you'd expect from the strength of its numbers. And I think that's why we've seen our clients selling around that £68 mark.
Connor, we've run out of time. Brilliant stuff. Thank you very much.
Thanks.